Welcome back. You're watching The Money Show on ET Now. And now we're going to kickstart our Meet Your Fund Manager segment. The fund that we would like to talk about today is called the Kotak Emerging Equities Fund. So if you, have this fund in your portfolio or are interested in knowing a bit more about it, are interested in investing in it, listen up, because in a short while from now, we are going to be literally meeting the fund manager of the Kotak Emerging Equity Fund. Riskometer indicates that it's a moderately high of risk when it comes to its nature. So perhaps if someone has got too low of an appetite, well, then you shouldn't be in equity markets in the first place. But yeah, just be a little, it's important that you note this. Now let's take a look at the returns. It's certainly been able to deliver extremely well, especially in the last 1 year. A 14% return in the last 1 year at a time when the markets were struggling, at a time when a lot of small caps and mid caps were struggling. The 10-year return, however, of course, is definitely best. 15.7% is the CAGR in the last 10 years, which again points to the benefits of long-term investing. And for 5 years, the fund has managed to deliver about 8.88%. So not bad over there. And it's quite an interesting group of stocks where it has a lot of exposure. Here are some of the top holdings. There's roughly 3.7% each in, firstly, fertilizer company Coromandel International, and secondly, Supreme Industries, which essentially manufactures plastic products. Then you have agrochemical major PI Industries, where it has about 3.5% of its AUM invested. Schaeffler India, this MNC has Kotak Emerging Equities put in almost 3.2% of its AUM. Then South India based cement company Ramco Cements is about 3.12%. Another 2.87% of its AUM in AU Small Finance. Atto Limited has 2.71%, as does Thermax Limited, which, as we know, is a cap goods major. Tara Global Beverages, as we know, that stock price has rallied, and how in the last couple of months. So I suppose, Kotak Emerging Equity as well as the fund must have benefited from that rally too. 2.28% of its AUM is in Tata Global Beverages. So that's quite a nice chunk of money put in this company. And Kajaria Ceramics, 2.18%. So there you have it. The top 10 holdings are largely concentrated around the mid and the large cap names. You could say Nifty top 100 of sorts. And interestingly, while of course a majority of its companies are from the financial services space, because the top sectoral holding is 18.9%, compared to its benchmark, it is a little underweight on financial services. What interestingly it's significantly overweight on versus the benchmark is the industrial manufacturing space, where it has about 15.7% of its AUM. Consumer goods is 10.75%, fertilizer 7.24%, and pharmaceutical has roughly 5.72%. So let's try and understand the rationale behind being so optimistic on industrial manufacturing and all the other stocks as well. And what can we expect from Kotak Emerging Equity Funds? Today we have with us Pankaj Tibrewal. He manages the Kotak Emerging Equity Fund. And thank you, Pankaj, for joining us on this edition of our Meet Your Fund Manager. The last 1 year, you've really managed to deliver quite an alpha for your unit holders, a nice 14% return seen in the last 1 year. So kudos on that. What's the basic theme? I mean, just to sort of introduce the fund to our viewers, what's the basic theme of the Kotak Emerging Equity Scheme?
So Kotak Emerging Equity is a mid-cap oriented scheme where 65% of the portfolio on a minimum side has to be invested in mid-cap stocks as defined by SEBI. So today the range is from 101 to 50th market cap, and the range cutoff is about 9,000 odd crores on the lower side and ranges up to 27,000 crore on the upper side. So clearly there are about 150 companies, and out of which 65% of the portfolio minimum needs to be part of it. The rest 35% could be part of mid cap, small cap or large caps.
Okay, so that's essentially the split also between large caps and, mid caps, small caps, which is also mandated, by the way, by SEBI. Okay, now, Pankaj, the name suggests that it's an emerging equity fund. So I suppose you have to pick and choose the emerging stars, for the fund. So how do you do that? I mean, I'm sure you must be having a screening or a filtering process to ensure inclusion of only good quality businesses and managements in the fund. What is that? I mean, how do you ensure that you weed out the bad companies or, those that could be underperformers and put in only those companies that do show promise or potential?
That's a very good question. I think whatever the outcome all of you see as the performance or the NAV is the result of two inputs which goes inside any portfolio. One is the stock selection, and another is the portfolio construction. From a stock selection perspective, we have a template where we try to look out for good competitive businesses which have reasonable amount of moat or competitive edge, and we ask ourselves that what's the right to win for this business over longer periods of time. It could be technology, it could be distribution, it could be brand, or something else. The second part, I think we always believe that we are piggybackers, and piggybacking on right set of promoters and management is very, very important in the mid and small cap space. Identifying the right set of promoters, I think, is the toughest job of identifying the right multi-baggers in mid cap space. And we do a lot of analysis speaking to the ecosystem to find out which are the right promoters or managements. The third important point which has helped us avoid big mistakes in this cycle is following the simple investing principle or mantra that top line is vanity, bottom line is sanity, and cash in bank is reality. There is no point in investing businesses which only work for top line if it doesn't convert into profits, and there is no point of accounting profits if it doesn't convert into cash flow. By following the simple philosophy and giving precedence of balance sheet and cash flow to P&L and accounting profits, we have kind of made less mistakes in this cycle, and that has helped the funds. And our belief is in this segment, which is a large universe, you need not always try to hit a 6, but there are times in the market where you need to defend yourself as well and make less mistakes. And we all will be surprised when we make less mistakes, how good things can happen in the portfolio. The fourth thing is, and the important part is, that over a longer periods of time, whether that business can generate return on capital which is higher than the cost of equity. I think we believe in Buffett's principle that over a longer periods of time, return on equity and return on capital ultimately decides the value of the business. And any business which generates less than the cost of equity will ultimately destroy the value of the business. So we are very, very careful that what's the edge which this business has, which can generate return on capital and return on equity higher than the cost of equity. So these are some of the basic investing template principles which we follow from a stock selection. Then comes the portfolio construction, where we act as a risk manager in terms of what should be the sizing in terms of stocks which we own, how much underweight, overweight we should go on a stock versus a benchmark. Following and combination of these two parts is ultimately what's the outcome of the fund is. And clearly this fund is focused on bottom-up stock selection, focusing on right businesses which over a period of time can compound our wealth.
All right. Okay, understood. Well, yes, at the end of the day, cash is king, right? And I think that the cash flow itself, that statement itself will tell you the whole story of what's gone on in the last quarter. Like Pankaj mentioned, top line is vanity, bottom line is sanity, but cash is the only reality. And I think that's a great, a parameter as well to judge companies. And that's as well what Pankaj follows. Okay, Pankaj, you have a very high weightage to industrial products and fertilizers as well, quite niche, industries. Usually mutual funds have the most exposure to banking and financial services. And while that's where you have the most exposure, you're actually a bit underweight over there compared to the benchmarks. You're overweight industrial products. So what exactly is it that's making you so optimistic on them?
So first one, let's talk on rural. I think this year our view is that rural could throw a positive surprise. If you look at the last 3-4 months, the agri-inflation is back not only in India but globally. And after almost subdued last 3 years, we are seeing either higher single-digit or double-digit agri-inflation coming in, which bodes well for the farmers. The second point is that the Rabi season has been very strong. The sowing under Rabi has gone up by almost 7 to 8% as we speak till January 10th. And at some point of time, if the crop output is good, the farm income will reflect that with a lag. The third and the lesser discussed fact is the wealth effect of gold. Our sense is that Indian households have got richer by 15 lakh crores over the last 1 year because of the gold price increase. And mind you, a large part of gold in India resides in the rural areas. and that wealth effect and the feel good factor should aid consumption, which should bode well for the rural economy. So that's why our overweights on fertilizers, agrochemicals, and something to link with rural areas. The second point is speciality chemicals. We have been overweight on this sector for last couple of years, and that has worked very well for the fund. Our sense is that the supply chain has been shifting from China to India, and some of the larger guys have been benefiting out of it. When we speak to most of the companies, the sense we get is that the demand is so strong that we don't have capacities to cater. So clearly from a next couple of years perspective, the demand visibility seems to be very strong. However, we need to be mindful of the valuations because these are B2B businesses and not B2C businesses, which can command higher valuations. The third is on the banking and financials, where we believe that there's a larger runway for growth. Clearly the market share is shifting in banks and non-banks from PSUs to private, and that trend is becoming stronger day by day. By owning some of the strong franchises in this space, we believe that the compounding is for sure over a period of next 3 to 5 years. That's why our belief in the financial services.
Okay, excellent, Pankaj. That really, I suppose, would help our viewers out taking their decision. Now, you know, the Kotak Emerging Equities riskometer is at moderately high. So you could say it's a bit more risky. But would you say that then those investors who are extremely conservative, don't have a very high risk appetite, it may not perhaps be suitable for them?
Not really. I mean, if you look at last decade, Nifty has returned about 8.5–9%, and the mid cap has also returned the same return, but with maybe slightly higher volatility. So I would believe that this fund is suited for people who would look for some extra return over a longer periods of time compared to large caps, because India is still a under-explored market, under-research market as far mid-caps and small caps are concerned, and there's a tremendous scope of alpha generation. In your opening statement, you mentioned that though the mid-cap index has been down, we have been able to deliver a significant alpha over the last 1 year, 3 year, 5 year over the fund. And that's been because of bottom-up stock selection and focusing on right companies, which can transit themselves from mid to large. And I believe that if investors are patient enough and come with a 3 to 5 year view, this segment has enough potential to surprise you on the upside.
Well, like we always say, right, you have to invest in the mutual fund market with patience on your side. You need to ensure that you exercise a lot of patience, you know, and then should you invest in mutual funds. And I suppose that's the reason why you could really reduce your risk as well. Now, like you said, Pankaj, you've been able to generate quite an alpha in the last 1 year, in the last 5 years since inception. So going forward, what sort of return expectations and also time horizon for that matter should prospective unit holders and current unit holders have for the Kotak Emerging Equity Fund?
So as I mentioned, it will be difficult to give you any sense on return expectation, but yes, this segment will have a higher volatility than large caps, and ideally a 3 to 5 year time horizon should be needed for anybody coming into this segment. We believe that as you transit yourself from $2.7 trillion GDP at some point of time, maybe given 1–2 years here and there, to a $5 to $6 trillion GDP, there will be many businesses which will be much larger in size than what they are currently today. Look at many of the segments which are just represented by mid and small cap segment. Look at agrochem, look at fertilizers, look at pipes, look at cement, look at infra companies, ex-L&T. A large number of segments where growth will happen are represented by mid and small, and I have no doubt that at some point of time these companies will transit themselves to a larger size. The key lies in stock picking. It's just not that sectoral theme will work. You need to dig down and get the right companies and the management as the template which I explained you some time back.
Okay, well, thanks so much then, Pankaj, for joining in on this edition of the Meet Your Fund Manager segment. Folks, I hope this interaction has helped you take a decision on investing in the fund. And if you're a current unit holder, I hope it's given you information as well with respect to the Kotak Emerging Equity Fund. Okay, now what we'll do is we'll take a very short break right here on the show, but don't go anywhere. We will be talking to Bank Bazaar on their latest Money Mood report that throws up interesting trends on the average loan taken by the Indian consumer.